What is the mortgage types, how they work, and example? What is the mortgage? A mortgage is a type of loan used to purchase or maintain a home loan and other types of real estate. The borrower agrees to pay the lender over time, typically in a series of regular payments that are divided into principal and interest. The property then serves as collateral to secure the loan, and borrower must apply of a mortgage through their preferred lender and ensure that they meet several requirements, including minimum credit scores and down payments. Mortgage applications go through or a rigorous underwriting process before they reach the closing phase. Mortgage types vary based on the needs to the borrower, such as conventional and fixed rate loans. Key takeaways: mortgages are loans that are used to buy homes and other types of the real estate. The property itself serves as a collector for the loan. Mortgages are available in the variety of types, including fixed rate and adjustable rate. The cost of a mortgage will depend on the types of loan, the terms such as 30 years, and the interest rate that the lender charges. Mortgage rates can vary widely depending on the types of product and the qualification of the applicant. How mortgages work: individual and business use mortgage to buy real estate without paying the entire purchase price upfront. The borrower repays the loan plus interest over the specified number of years until they own the property. Free and clear. Most traditional mortgages are fully amortizing. This means that the regular payment amount will stay the same, but different proportion of principal plus interest will be paid over the life of the loan with each payment. Typical mortgage terms are for 30 or 50 years. Mortgages are also known as liens against property or claims on property. If the borrower stops paying the mortgage, the lender can foreclose on the property. For example, a residential home buyer places their house in the lender, who is then has a claim as the property. This ensures the lender interest in the property should be by default on their financial obligation. In the case of foreclosure, in the lender evicts the resident, sell the proper property and use the money from the sale to pay off the mortgage debt.